Okay, so equity, again, a difference between market value and the balance of the loan. So again, there's two ways you can get equity. The value increases. I think somebody is not muted. Let me mute everybody. So the value of the home increases, the loan goes down. The difference between that is your equity. Here's an example of what equity looks like. So if you look here, you see the debt over 30 years. You see year one on the left-hand side of the graph and year 30 on the right-hand side of the graph. You see the green part is the debt, and you see that line going down. You're reducing debt. At the same time, your equity is going up. It means the value of your house is going up. You're getting equity. Any questions on equity increase? As debt goes down, equity goes up, value of the property goes up. All right, let's talk about number 4. The number 4 way that you get paid, and you get paid through what we call depreciation. And this is the good depreciation that I was speaking to you about earlier. The IRS will allow you to depreciate the value of the asset over time. And when I say depreciate, that means they will give you a credit on your tax bill for a certain amount, depending upon what type of asset that is. And I want to explain to you how they figure out what the depreciation rate is. Real property, that is real estate, is depreciated over 27.5 years. So whatever the value of the property is, if it's $100,000, you divide it by 27.5 years, and whatever that amount is, that's what you get as a credit on your tax bill that particular month. And so it's an actual credit that you get to take, right? I mean, it's not a dollar that you're going to be given. It's just if somebody gave you a grant. Most of you all know what credit is, so that's the credit that you get from the IRS. Let's take an example here. You purchase it for $100,000. You divide that $100,000 by 27.5. You get to deduct $3,600 right off the top as far as depreciation on that property. That's like having $3,600 in expenses that's coming right off of your taxes. So let's see that through. So let's look at a property. Let's assume we purchase this property for $100,000. And of course, everybody, you know, or if you don't know, you'll learn this, that we like to use the 1% rule. If you pay $100,000 for a property, the 1% rule says you should at least get $1,000 a month rent for that property. Okay, so that means $12,000 a year in rent income is what you'll be getting. And let's just assume that the principal and interest on this particular $100,000 property, you're paying $619 a month just for the principal and interest on this. So that's about $4,100 in interest a year. And then let's say you pay in property taxes, you pay $60 a month. So that would be $720 a year. You'd also have insurance at $50 a month, which would be $600 a year. And then if you have any maintenance, let's just assume you have maintenance at $100 a month, that would be $1,200 a year. Now let me show you what your taxes would look like on this property right here. All right, you had this property, you got this rent, this is what you were paying out, this is what your taxes would look like. So you made $12,000, and so that's the income. You got $1,000 a month, $12,000 a year. Less, remember I told you, you're going to get depreciation that the government is going to credit you right off the bat. So you're going to get that $3,700 depreciated for that house. The interest that you paid on that principal and interest, the interest piece of that, you get to deduct that on your taxes, not the principal, only the interest. And then those taxes, those property taxes that you pay, you get to deduct those. So in our example, it was $720 a year. Then we also have to insure the property in case it breaks down, in case somebody burns it down. You want to be able to get your money back out of it, so we always have insurance. And let's just assume in our example that we have $1,200 worth of maintenance. We had to repair some lights, we had to do some AC repair, maybe have some plumbing issues. And I am so sorry. I apologize. I don't know what's going on. Can you guys still hear me now?
Yep.
All right. Let's go back again. I'm going to go back through this one again in case you missed it. So we have $12,000 in income, and we have depreciation that we're going to get. Remember, I talked about that 100,000 divided by 27. We have interest, we have taxes, we have insurance, and then we also have the maintenance. And so we have $10,000 in deduct that we're going to be able to deduct from that $12,000 in rent that we had coming in. So the government is only going to tax you on $1,593 because you had $12,000, but he allowed you to reduce that taxable that income by $10,000. All these expenses, including depreciation. So that means you're only going to show $1,500 that you made on this property, when in fact you had income of $5,200. And the reason why that is because that $3,700 of credit actually reduced your taxable income. So let me stop right there and see if we got any questions.
I sure do, man. So you telling me that you get to deduct for depreciation, the interest, the taxes, the insurance, and the maintenance, and all that goes into your deductions for the year for the property that you own?
Yes, sir.
Wow. Okay.
That's how you get paid, babe. I'm trying to tell you, that's another way you get paid that no other asset class is allowed to do, because real estate has all of these ways you get paid that other places don't.
How does it factor in for the depreciation? I mean, where do you put that in for your taxes? I mean, where does that go?
So when you, there is a depreciation schedule that your accountant will fix up for you, and they will automatically apply that depreciation for you on your taxes. So if you file a 1040 or 1041, you won't see a place for that. You'll have to file what we call a K1, and that's where you show your real estate assets and what you're doing in your real estate. So you'll have K1s for your real estate, and then whatever that balance is will transfer to your taxes. So it's a whole different spreadsheet that's applied in, Don. And I don't have my computer here. I could show you on my taxes what it looks like. If you remind me, I will show you that, exactly what it looks like. Who else has got questions?
Yeah, Mr. Ray, what about when they miss payments?
When the tenant miss payments?
Yes.
That means you make the payment.
I understand that, but can I know I got to make the payments, but like, can I report me having to make those payments?
Can you do what?
So you see how you deducted that?
Yeah.
Can you put that anywhere on there, or do you just kind of
As far as losses?
Yeah.
No, what you would do if they don't pay, then part of that $12,000, let's say they don't pay 1 month, then your income is only 11,000. Or if it's vacant for 1 month, you know, they don't pay 1 month, it's vacant 1 month, then your income is only 10,000. So that's where it shows on here. That make sense?
Absolute sense. And what about, and the same concept with partial payments as well?
Yeah, whatever, if you were expecting to get $12,000 for that year, whatever amount you got is what you're going to show in income, right? Well, however much rent they paid you, that's the only income you're going to show.
Okay, thank you.
Sure. Who else? 5 ways, baby. 5 ways you get paid. So that was a good question that you asked there. So here's the other things that you get to deduct. It gets crazy. I just told you about depreciation and taxes, insurance, all that stuff. Let me show you all the other things you get to deduct on your taxes also. You get to deduct the part of the cost, your points and your closing costs when you buy a new property. You don't get to deduct the cost of the house because remember the government's only going to allow you to deduct that over 27 years, right? So you get to take that depreciation. That's kind of how they're giving you the value of the house. They're giving you that depreciation deduction every year for 27 years. So you get to deduct your closing costs. We talked about the mortgage interest, part of your principal and interest. You get to deduct the interest. You also get to deduct the real estate taxes. We talked about that already. Now, let's say all your traveling expense, let's say you're going to buy a house in maybe Miami, and you're going to Miami to look for this rental property. You get to deduct all your traveling expenses. That is your fare to the airport, your airport fare. You get your where you stayed at, the food, all that. You get to deduct if, in fact, you were doing that as part of your business, getting real estate. Advertising. When your houses are vacant, you got to advertise them. We now understand that Zillow is now charging, I believe it's a weekly fee now of $9. I got to go back and check. They used to be free on Zillow. Now you got to pay to advertise your rental property on Zillow. Insurance, all your insurance, you get to deduct that on your taxes. Any professional fees, attorney fees, when you evict people, all those fees, everything is all your tax preparation fees, all those are deductible. Capital expenditures, you have to buy a new heat and air unit, you get to deduct that. Now, I think they allow heat and air units to be deducted over 3 years. So if you paid $5,000 for a unit, you divide that by 3, you get to deduct that over 3 years. All your repair and your maintenance, utility, all that is deductible. We already talked about depreciation. Mileage, as you driving your car around, you get so many miles that you get to deduct. Let's say, I think it was 50 cents a mile. I got to go back and look at that. But all the mileage, when you're looking for property, when you're going out to your property, whatever miles that you're driving, if you keep track of that, you'll get to deduct that on your taxes. All your office supplies, or your printer stuff, if you buy a computer, you get to deduct that. That's all deductible as part of your business expense and any utility expenses you might have. And I'm sure I'm missing some things, but pretty much everything you spend, you get to deduct. Any questions? It's good stuff there. I love. Yes.
And I just would reiterate that these are all to your benefit, but it's important that you have to document them. Like, so if you are driving, you need to get you a log so you can capture all your miles and all that. Don't try to wait till the end of the year and come up with something, because then if you do get audited, you don't have any good record. So just wanted to reiterate that. Of all these expenses, you need to be logging them, filing them in some format.
Yes, yes. Make sure you keep up with receipts. Make sure you keep up with all your expenses. You have to be able, IRS, they reserve the right. They tell you to keep 2 years plus. So you want to make sure that you keep at least 3 years of all of your expenses that you can document if the IRS ever comes back and tries to say that these are not legitimate expenses. Good point, Johnny. What else? All right, let's keep going. Oh yeah, baby, the net cash flow. This is the numbers that make all the sense. And this is the number. This is the fifth way you get paid. I don't know why I got $5 up there. I meant to say number 5. Net cash flow, baby, the fifth way that we get paid. Let's use our example again. So we get $1,000 in rent after we pay our principal and interest, taxes and insurance, vacancy maintenance. This is the amount of money we get to put in our pocket. $186, baby. Net cash flow goes right in your pocket. That's how you become millionaires. So let's look at this. This one property that we just talked about. What was my total increase in net worth in this property for the first year? Let's look at that. So let's just assume, I'm making an assumption, that my $100,000 house appreciated 1%. So I get $1,000 in asset appreciation. But I also paid down that loan $2,900, right? Now there goes my little depreciation credit, right? IRS is gonna give me that $3,700 credit on my taxes. There's the equity increase. That's the difference between the appreciation of 1% and the loan pay down. It's the 1987 base. So I got that in my net worth. And then remember I got my little cash flow going also. So if you add all of that up, that one property, I got $11,000 increased net worth on that one property in 1 year. You say, Ray, that's not a lot of money. It's gonna take me a long time to be a millionaire at that. Wait a minute, that's not it. That's just assuming you had one property, right? What if you had 10 properties? And that's just 1 year. So think about it. That's why I love long-term hold strategy. The longer you hold it, the more money you make. You get paid 5 times every year. That's how millionaires, real estate millionaires, are made through real estate. Because people think, well, it's just the difference between what I pay and what the what my mortgage is, and I get to keep that. That's the only way I get paid. No, I just showed you. You're getting paid 5 different ways. And if you kept that one house for 10 years, you've added $100,000 to your net worth. So all you would need was 10 of those properties, right, to be at a millionaire. That's how you become minority real estate millionaires, people. That's how you do it. That's pretty much all I've got for the day. What questions you guys got about that? Isn't that good stuff? 5 ways getting paid. That's why you should be getting as many properties as you can, as fast as you can. As much as the bank will loan you the money and it makes sense, the numbers look good, you need to be acquiring property. Questions, comments? You guys are good. You got it. I don't hear any questions.
Yeah, I got a question. Well, I know you weren't talking about it, but you mentioned equity. Have you ever used the equity as a loan to buy new property?
Yeah, you can have a home equity line of credit that you can take on your house. Banks love giving you that. Let's say again, you have $100,000 property, you pay that loan down to $50,000. Now you own 50, so you got $50,000 in equity that the bank would love to give you a line of credit on that 50,000. You could take that and go buy other properties with it. Absolutely.
I would like to know a little bit more about that. I know you just kind of explained it, but can I get with you tomorrow just to come up with some ideas that I've been thinking of, talk to you about?
On the home equity?
Yeah,
Or
in the
just in
sense
general?
of using that. Just in general, in the sense of using a home equity line. I've been hearing about it a lot lately, so it was one of those things I kind of want to run it by you and see what you thought.
Yeah, absolutely. Just holler at me tomorrow.
Mr. Ray,
Yes.
when you're talking about deducting utilities,
Mm-hmm.
are there pros and cons if you rent your property and include utilities as part of that rent to be able to deduct that cost? Is it worth it?
I always make the tenants pay the utilities. If they pay for them, then you don't get to deduct it, right? The utilities I'm talking about is when you're holding the property. Let's say you're in between tenants, so you got to have gas, water, electric on so you can get ready for the next tenant. Those were the utilities I was talking about. So normally, as a landlord, we make the tenants pay all the utilities. So therefore, the only utilities we get to deduct are the ones that we actually pay for when the property is in our name and the utilities are in our name. Does that make sense, Kendra? Or was there another question?
Yes, that makes sense.
What else? Foundations class, baby. We finding out how we're gonna make millionaires. Good to see everybody today. David, I know you had asked me a question about getting you last week's, and I'm working on that. Again, technical difficulty. I'm going to hire somebody that's going to technically take care of all these technical difficulties. I did find out why I was dropping today, though. Lila was trying to log on while I'm using her computer, so it wouldn't let two of them be logged on at the same time. So we make sure that she doesn't get logged. Anyway, my computer was going crazy. I'm using hers. Never mind. We're here. Any other questions?
Hey, Ray.
Yes.
Hey, Ray. Would you kind of maybe expand on the lady's question about, have you ever considered making the tenants pay for you put the utility bills within the actual rent amount?
Go ahead, expand on
or what's the pros? No, so would you go ahead and expand on it? You missed the Ray.
I thought I answered the question. Maybe I missed it.
No, I'm just saying, like, have you ever thought about making putting it into your actual rent amount? And is there any pros and cons to why you don't?
Okay, so yeah, that's a good question.
I think you touched on it.
I should have caught that. So the reason why I don't like to include it, because if the tenant is paying for it in their rent, then they don't care if they run that air condition all day long, right? They can just be running it, be on. They don't even put it on auto. They can just let the water just run rolling down the street. I mean, so at that point, I'm responsible for it. So I don't like to have that risk. I do know that there are like apartment complexes that include water as part of the rent. I think that's cool. Some of them have all bills paid. I just think the incentive is not there for the tenant to be efficient, right? They want to save me money, so therefore I don't want to bear that risk. If they just running it up, let's say I just put $100 in there a month for utilities, and they're running it up to $300 a month. Well, I'm losing money all day, every day. So for me, I don't think that's a good deal. For others, they may put a big enough amount in there to cover those expenses, but I think there's some risk in there. So that's why I wouldn't know. Other questions? Any other questions? This one right here, this is where you make the money right here, baby. This is where you want to get that taxable income down as low as you can. In fact, you want it to be zero or negative. If you're Donald Trump, you want that to be $26 million to the negative, so you pay $720 in taxes. That's what you are. And that's how he did it. He did it through his real estate investment. All those losses he was able to apply, and he did it legally. You can do it. Now, he may have inflated the value of the properties and done some other stuff he wasn't supposed to do. But as far as taking those losses, he was okay. The tax law allowed him to do it.
Hey, Ray.
Yes.
Yeah, speaking of taxes, are all CPAs pretty knowledgeable in these real estate benefits, or do you have to have like a specific
Yeah,
CPA
you gotta ask around. There are some that really specialize in it. So
Okay.
you want to make sure that you get one that's familiar with real estate, so you can take advantage of all the deductions and benefits that you have as being a real estate investor.
Okay, that makes sense.
All right. Any other questions? See what else? Did I miss anything else? Yeah, I like this slide right here, baby, because it's showing that equity increasing as that debt goes down. That's where you make the money, and you allow the tenants to pay that down for you. All right, 7:46. I'm gonna give you one more chance to ask any questions before we end the call. All right, very good. We will see you, for those of you all that will be attending Thursday's advanced class. We will see you then. Have a great evening.
Thank you, Mr. Ray.
We'll see ya.
Good evening.
Thank you.
Thank you. Hey, Don, are you still there? You may have logged out.